QuickBooks Online 2025 Expense and Vendors Reports. Get ready and some coffee because we're learning how to save time with QuickBooks Online 2025. We are online in our browser searching for that QuickBooks Online test drive, the free sample company file available to everybody looking for the result that has Intuit.com in the URL because Intuit is the owner of QuickBooks. We're going to be choosing the United States version of the software, and then we're going to have to go through this very sophisticated test to make sure the AI is not invading, checking off that I am not a robot. Boom. Continue on. Tabbing to the left. We're going to close that out. Not people know that secret code to get into this practice company file. We're showing it to you here. We're telling you how to get into it, how to hit the buttons, left, right, A, B, forward, space, and so on. And now we're in to the practice company file. We're in the sample company, Craig's Design and Landscaping Services, going to the reports on the left-hand side. We're in the reports, standard tab, favorites. We're going to open up the balance sheet like we do every time, right-clicking on it to open a link in a new tab. Same for the P and the L, the profit and loss. Right-click, open it, and a new tab. Let's go to that middle tab. Close the ham boogie, and change the range. 010124 tab, 123125 tab. Select the drop-down, and we want to see it in years. And then run it so we can refresh that thing. 2024 and 25 are now side by side. Let's do the same process on the right side for the next tab. Report needs to be closed. We change that range 010124 to 123125. And then we select the drop down and we say years. And then we run it because we want it fresh. I only deal with fresh reports. Don't you get me no moldy old hard bread report. It's going to break my teeth when I'm trying to chew on it. No, we want fresh reports that have just been run out of the oven. Okay, so now we're basically looking at other reports. All other reports typically giving us more information about one or multiple line items on one of these major financial statement reports. This time we're looking at more information about the income statement reports, which are, of course, performance reports, meaning they need a beginning date and an ending date. In the prior few presentations, we talked about the first half of the income statement, basically the income or revenue part. Now we're going to be focusing more on the expense part of things, more on the normal expenses rather than focused on the cost of goods sold, which is a more specialized expense if we have inventory, dealing with the cost of inventory that we sell. We're mainly going to be down here on all of the other expenses, which is like the longest, most expansive category, having the most different accounts within them. Why is that, by the way? Well, because the performance report, when we think about what we're doing, we're specializing in a particular thing. We sell a particular thing. Therefore, we typically only have categories of one or two or a few items, usually like revenue or maybe inventory revenue, service revenue. But on the expense side of things, we pay for everything else we need in order to help us generate revenue. Therefore, we're going to have more expense categories than any other category within the types of accounts in the business, whether that be on the balance sheet or the income statement, typically. That's where the most work comes in terms of how we're going to organize our accounts to make it clean, but still functionable, giving us the detail we need while not giving us a ridiculous amount of detail that actually gets in the way. So, but of course, we hope that the dollar amount of the expenses that we expend in all of these categories, total dollar amount, of expenses is less than the total dollar amount of revenue, because we want to make more money than we expend to generate that money. That's how business typically works, unless you are in a not-for-profit, which, you know, they're like a business that can't make it as a business. I'm just kidding. Don't get mad at me. I'm just saying they're like the government, right? They don't know how to do business, so they went into government. And they get it all backwards. They just spend money ridiculously. And it's like, what are you doing? You don't know what is happening. Get out of here, for crying out loud. Can't we get someone that's not crazy? Okay, back to business here. So anyways, when we looked at the revenue side of things, we saw that we can break out the revenue reports into subsidiary type reports breaking it out by customer, and breaking it out possibly by what we sell items. Now we're on the expense side of things, and you can imagine that we might want to further break out the expense type of things by who we purchased from. So remember, when we record things on the expenses, it's most likely that we're able to use the bank feeds to automate the recording of the expenses. That's really usually when, especially for small businesses, the use of the bank feeds adds to the ease of us constructing our books, makes things a lot faster, because when we pay for things, we can do electronic transfers, possibly wait till they clear the bank, and then use the bank feed to record them. Now, the information that we use to record them is usually by who we paid. So that meaning if I pay the telephone company, it went to AT&T, it went to Verizon, or whatever. If I pay the utility company for electricity, for example, it goes to the Edison company or SoCal Electricity or whatever. But we're going to use that name then to assign it to the account. So the information that we get is usually who we paid that we then convert to the account, meaning we pay the telephone bill, we take the electric bill, or we just dump it into the utility account. So that means that all of our accounts here are not broken out by who we paid, not usually, just like the revenue account is not usually recorded by who paid us, by customer. We're not recording the expense accounts by who we paid, by vendor, but what we paid for. We're not recording, again, the Verizon expense, that's being who we paid. We're recording telephone expense, what we paid for. That then leads us to say, well, I could break out then the expenses by who we paid. That might be a useful subsidiary type reports. So I'm going to go over this terminology again because I think it's important, and I think we lose it sometimes when we get into the QuickBooks. So if I go to the first tab, the balance sheet, sometimes it's more clear here with something like an accounts receivable. So if I go into the accounts receivable, drilling down on it, we get to, from a book standpoint, textbook, what we would call a general ledger report. They call it here a transaction report. That gives us the information by date, the forms that we used to construct this account. If I go back, then note that that might not be the only way we want to break out the information. We might want to break it out, in this case, by customer. I would call that a subsidiary ledger report by customer. So similarly over here, we have the expense accounts. Now there's a whole bunch of the expense accounts. They're expensive accounts. If I go into any one of them, then I'm going to get, once again, from a textbook standpoint, a general ledger type of account. From QuickBooks, they call it a transaction report, breaking out what constructed these accounts by date. And then it gives us the forms. Usually the forms used to construct expenses are going to be expense forms if we use electronic transfers, which are a type of check forms, which is what we typically use to decrease the checking account, although they could be a credit card, payment that we have expense forms with a credit card, for example. But let's go back, or they could be a bill form if it was on an accrual kind of component, which oftentimes is not used as much for small businesses. More larger businesses are more likely to enter bills and not just pay expenses as they become due, with more likely electronic transfer, which would be expense forms, or actual physical checks, the check type form. So if I look at all of the expenses as a total, then, like if I collapse this to my total expenses, I could imagine a subsidiary report that's going to break out the expenses by who we paid, by vendor. Now, when I look at the subsidiary reports on the balance sheet, as we've discussed before, like accounts receivable, they will almost always tie out, when using QuickBooks at least, to the parent account, because QuickBooks will not let us post to accounts receivable without having a customer. Not the same way for the income statement accounts like the expenses. It's possible for us to post something to an expense and not have a vendor, which means that the subsidiary ledger that we break out by vendor won't tie out. So how would that happen? If I hit the drop down, remember the things that create expenses will typically be the form of an expense form which possibly is used when we create the bank feeds. That's the major form used when we pay for things out of the checking account and record them with the bank feeds, or check form, which is the same kind of form except it has a check number, or we enter a bill type of form. So if you enter these three forms, any of these forms is going to have a vendor component to it. We'll enter the vendor, like the telephone company, allowing us that added level of information, allowing us to make a subsidiary report broken out by vendor. But I believe it's actually possible not to add the vendor and still record these forms, which you probably wouldn't do if you were doing these by hand in a full service accounting system, but you might mistakenly do if you use the bank feeds. So I'll touch on that in a second. Now, you could also have an expense form that was hit with a journal entry, which might be done, say, at the end of the year, where you might have adjusting journal entries so that you can make your financial statements more correct for tax purposes and or external reporting purposes. And that will, if you hit something with a journal entry, will almost surely throw off your subsidiary report because they're not going to enter vendors. So just be aware of that. Also, if the subsidiary report is thrown off, isn't the same, that's not the end of the world, because at least it'll start over, because the income statement reports refresh. We can think of it on a yearly basis. Then next year, we have another chance to start from zero, whereas the balance sheet account reports don't do that, which is possibly why QuickBooks forces the balance sheet account subsidiary ledgers to be in balance, because it's more of a problem if they're not going forward. All right, let's go to the first tab and check this out. Now, I just want to point out before I get into this, if I go to the transactions over here on the left and I go into the bank feeds, I'll close up the ham boogie up top. If I'm in the checking account and I'm going to record something that's like an outflow, like let's say, are these outflows? What's going on? Spend money, outflows. So if I recorded like this thing here, it's got a match. Let's say it wasn't matched. Notice I might have something, it doesn't have anything in the memo. For crying out loud, let's open this one, get rid of the category. So let's say in the memo, typically, we're going to have the bank detail, which is, here's the bank detail information. Now, it's possible, even though you have the bank detail information, to not populate the vendor up top and just assign it to a category. If you did that, it might still let you record it, meaning if this field was blank, I might still be able to assign it to a category and record it, which would basically generate an expense type of form. The financial statements would still be correct, but you would lose some detail. It might not be the end of the world. It's not going to kill you or anything. You'll still be able to do your taxes possibly and whatnot. But if you wanted to then track the information by vendor, you're not going to be able to do it as easy because you didn't add the vendor, which normally, if they're electronic transfers, you will have in the bank detail at the least. So you should have the information to add the vendor, and you want to make sure that you're doing that when you do the bank feeds. And that'll give you this added level of searchability that you might as well do because you have the capacity to do it. So let's go, and once you save all the transactions and memorize them, it'll be easy to do that automatically. All right, let's then go down to the reports and let's check it out. I'm going to close up the ham boogie and we'll scroll down to so we're on these expenses and vendors. So if I just look at that name, expenses and vendors, I'm typically going to be thinking, well, that sounds like an income statement type of report category, breaking down the expense area rather than the income or revenue area, because the expenses are the expense accounts, of course, and the vendors are who we pay for that. Noting you might think vendors also remind you or could imply that you're going to be on the balance sheet for accounts payable, but we saw that before in who you owe. That's where they put those accounts payable stuff. So we have the check detail. Now, this is something that would be, you would think, a balance sheet type of report because it's cash. But most of the time when money's going out of the business, you would think it would be for paying for expenses. So it kind of makes sense that they would put that report here. You can kind of generate these reports, by the way, by looking at the detail, drilling down on the transaction general ledger account for the balance sheet, and then sorting or filtering by the outflows of money. You can generate a similar report for the check detail, decreases to the checking account. 1099 transaction detail report. This is going to be for the United States, remembering that the people that we pay money to, we have an income tax system for the federal government at the least, possibly for the state as well. And the Fed then wants to make sure that people are reporting their income because they want a piece of the income. How could they do that? They have leverage on the person that's paying because you get a deduction for taxes when you're the payer. So when you're paying money out, just remember, this is just useful to have this hierarchy in your mind because from an auditor's perspective, this is kind of how they're thinking, right? The IRS would like for you to be dealing with people on an employee-employer perspective, making you the business owner, the employer. Why? Because then they can force you not only to report the income of the employee, but withhold it, right? Which means you're doing the work for them. So that's the structure that you would think they would want the most. If they can't get that structure, then they would still like you to at least to report the income, to rat out the other person that you're paying because the income is income to them. Now, if they're a big company, like you're paying the utility bill, then the government's not going to worry about it. They're okay because they already have their hooks into the big companies, right? They're colluding. The big companies are like colluding with the government. So they're already in bed together, right? So they don't need to go after like the large companies that are incorporated. They can't go under the radar. They've already got their hooks in. But the small companies, that's where it's a problem. So if they're an independent contractor, then the government's going to first question, hey, shouldn't they be an employee? And they're going to try to say that they should because they want you to then withhold for them. And if they're not employees, well, then they still want a 1099 so that they can still not let this small contractor go under the radar and not report the revenue. So that's the general idea. We'll talk more about 1099s later. Purchase by product service detail. So we can purchase by the things that we're purchasing by product, purchase by open purchase orders. Now the purchase orders are for inventory items. So when we think about purchases, we're usually thinking about when we buy inventory. So if you don't deal with inventory, then you're not going to have purchases. And even if you deal with inventory, you might not be in a situation where you have purchase orders because a purchase order is a request for the inventory, which means that you have more kind of power in the transaction. If you can say, hey, that would be like going to Amazon and saying, hey, Amazon, ship me over a new TV, give me like 5 new TVs and I'll pay for it once I get them. Once I get them, add the bill in there and then I'll pay for it when I get them. And Amazon's usually going to be like, no, you have to pay for them before we ship them. That's how it works over here, right? And so, but if you have the ability to request the inventory and not pay for it, that's kind of what a purchase order is, meaning then you're not going to record anything when you enter the purchase order, but will record it when you receive the goods and usually the bill with those goods. Transaction list by vendor. So now we got the detail of the transactions that are broken out by who we paid, vendor. Purchase order, purchases by vendor detail. So now we have the purchases again, vendor contact list. This is just who we paid. And then we're focusing here on the expenses by vendor summary. So let's right click and open this one. Finally, the one we're looking at. Open it up. Now we're dealing with an income statement type report. Close the hamburger. That means it's going to have a range, a beginning and an end, similar to our analogy of how far can we drive a car in a day, and then reset the odometer, noting that the expenses are still going up from the standpoint of expenses. So when you think about the income statement as like kind of how far can we drive in a day, we usually think like revenue. How much revenue can I earn in a day, a week, a month, a quarter, a year? Expenses are the same though. They only go up in kind of the bad direction, right? Expenses go up and then we calculate net income of income minus expenses. So we're still seeing how many expenses. We're trying to say like expenses are kind of like the gas in our car analogy, right? The gas is still going up, but we would like it to go up less, right? So we're saying how much gas did we have to use in order to drive as many miles as we could in a day? We would like to maximize the miles and limit the gas, maximize the revenue, limit the expenses. Okay, so we're going to go from 0101 to 4 to 1231 to 4, and let's run it to refresh it, and boom. So now we've got the expenses paid by vendor. We have the total at the 347666. If I go to the profit and loss, we've got the expenses over here at the 2536. And I don't think it includes the cost of goods sold. Yeah, I don't think cost of goods sold is included in this report. So 2536. So it doesn't tie out exactly, which is kind of what we expected, because it's possible for us to record transactions to expense accounts without recording the vendor, which means it would not be tied out that way. So this report possibly is not like, it's not the one that comes to mind as much as like breaking out revenue by customer or breaking out revenue by the things, the items that we're selling. But it still could be a useful report, and we might as well put the information in there in order to generate it, meaning whenever we enter the expenses, we want to make sure to enter a vendor, possibly not just to generate this report, but also so that you can like when you want to like drill down on detail and you have questions about whether you paid something, then you're typically often going to want to search by vendor to kind of figure it out. And if you didn't enter the vendors, then that's going to be a problem. Now, clearly, you need to track those vendors who you have to issue a 1099 to, because you're going to have to report those. You're going to need to know what you paid them for sure, because you're going to have to report that to the government. This is also a nice report that you could make a chart by, a pie chart. So if this number was accurate, if we reported a vendor for every time we hit the expense account, then you can make a nice pie chart by exporting to Excel, which we might do in a future presentation. It would be quite easy to do. So that's going to be the general idea. You know, if you've got to keep people happy with the business, you got to keep the people happy. You know, I got earphones one time, these earbuds, you know, those earbuds, and the company said that they're going to give me a happiness guarantee, which is kind of ridiculous if you think about it. The earbuds are going to give me a happiness guarantee. What are they, God? How could they possibly guarantee happiness, for crying out loud? How could earbuds give me a happiness guarantee? It seems like they're looking for a lawsuit to me, I feel like. So we don't want to do that generally. Or possibly they're listening for a lawsuit maybe, because they do listening stuff. I'm a bit paranoid by nature, and I generally use my earbuds to listen to politicians talk crazy, making me more paranoid. So I don't see how these earbuds could possibly make me happy at all, let alone guarantee my happiness. To be honest, I'm not even looking for them to make me happy. I'm just hoping they don't break. Just don't break, for crying out loud. They should not be trying this huge overreach of a happiness guarantee, and just go with a more practical and more believable they won't break guarantee. That's what I'm talking about. They won't break guarantee. A lot of companies are being sued for dishonesty these days. Most of them kind of colluding with the government and whatnot. You got a lot of shady business going on. You shouldn't be lying. If you're the company, you're kind of putting yourself out there to be sued. You shouldn't be lying about other people. That's not a good thing, especially if you're a news organization. It's really not a good practice. You might be able to do it for, you know, my entire lifetime, not get sued. But at some point, someone's going to be like, you're lying over there. You're lying. That's not right. And then it's going to hit the fan. So that's what I'm just saying. We on the bookkeeping side want to have everything lined up. So at least we're tracking. We're being honest over here on our side of things. That's all we can do, man.